Greetings, everybody. Welcome to the weekly wrap-up for, what day is this? Friday, April 29th, 2022, last business day of April. Thank God it's been a pretty shitty month for the markets, but hey, it was to be expected. I was totally prepared for this, but I think a lot of people out there in the, the normies who don't really pay attention to what's going on in the economy, in the markets, they may be a little caught off guard, but I've tried to educate all my clients and give them a heads up that, what we went through 2 years ago was just a prelude. And, we're getting ready to go back through the same thing we went through. Unfortunately, we don't have the same benefit of being able to lower interest rates again. Or, I guess they could lower interest rates back to zero and, flood the economy with a ton of cash again. But we've seen the result of that, here in the last, I'd say, 12 to 6 or 18 months. We've really seen the inflation spike up and all the problems that are associated with, the government trying to avoid something that they can, that you really can't avoid. Anyways, all right. So I hope everyone's had a fantastic week out there in the interwebs. It's a pretty beautiful day here right now in Colorado. It was a little overcast earlier, and I had to run out and donate some blood for some blood work and pick up some things from Lowe's and get some gas and stuff. But the wind out there, wow! I mean, what's the temperature right now? 58 degrees here at my house. My rule is if it's above 50 and the sun's out, I'm wearing shorts. So there we go. Gotta show them sexy legs off. But anyways, yeah, it's, hopefully it's nice wherever you're at. My wife is down in Phoenix for the day. She went to take a little mini vacation. She had some airline dollars she had to use up. So she figures, hell, I'll go take a trip over to Phoenix, and she's going to see the Chihuly exhibit there, which she's a big fan of Dale Chihuly. If you're not into glass art, you may not be aware of him, but she's been a big fan of his. Going back to when we met, almost 27 years ago. So we've been to a couple of his exhibits we went to one in Tampa, went to another in Seattle, which was pretty cool, right underneath the Space Needle there. But anyways, if it's your first time watching, I know I've rambled already for almost 3 minutes. Please give me a thumbs up, one of these. Woo! And give me a like, a subscribe, all that good stuff. Share with some friends and family. I'm sure there's some people out there who are worried about what's going on in the world. And, I try to give a daily commentary on what I'm seeing. And, I'll also go through, if there's any interesting articles that have, tips that can help you out or help keep you on the right path. But anyways, let's go ahead and take a peek and see how the markets did today. The Dow Jones finished down 2.77 at 32,977. The S&P 500 was down 3.63%, closed at 4131. NASDAQ got beat up again, down 4.17%, closed at 12,334. Small caps were down almost 3%. The VIX climbed 11.37% today. It's at 33.4. The other exchanges here in the Americas, Canada was down 1.7, Brazil down 1.86, Mexico down 2.27. Moving over to Western Europe, they look pretty good. Germany was up 0.84, the UK up 0.47, France up 0.39, the Euro stocks up 0.68, Netherlands up 0.72, Spain up 0.85, Italy up 0.82. Switzerland up 0.5%. Portugal was down, basically flat. It finished up down 0.04. A whole bunch of greens all the way down. I'm only going to point out the reds at this point. Poland was down 1.4. A lot of these are up 2-3%. The Russian exchanges were up 2.5 and 3.8. Moving over to the Asian markets, starting with Japan, we had they were up 1.75, Australia up 1.06, New Zealand up 0.47. The Shanghai in China was up 2.41, the SESE component up 3.69, the China A50 up 1.13, the DJ Shanghai up 2.47. The Hang Seng up 4.01. The Taiwan weighted up 1.05. And then it's kind of mixed here with these other small countries. So all in all, I mean, probably 2/3 of the day looked pretty good for the markets around the world. It was when we got here to the Americas that really got terrible. So anyways, let's take a peek and see how the markets did for the week. All right. So the Dow Jones finished down about 2.25. The S&P 500 looks like it was down 2.89. The NASDAQ finished down 3.14. Dow Utilities finished the week down 4.25. And the Dow Transports finished the week, looks like it did the best of all of them. It was down 1.13. So ugly week here in the Americas. Let's take a step back and look at the Dow on a longer term time frame, and we can see here, for those who've been playing along and watching these on a regular basis, I know I've talked about this, how after last year we broke this uptrend in, what month was this? That was about mid-August. We broke this uptrend, and we're in a downtrend for a little while, but then we broke that in October. And really since then, it's really just kind of been sideways since that time. We did really start in the first of the year. We things lined up, and you were able to really see where the lines of resistance were. And we did break out of that in late March, about a month ago. But, my expectation was that it would eventually fall back in line with this longer trend here, which it has. It typically, when you break a line of resistance, if it were to, then you'd see more of an uptrend, over the next, say 3 to 6 months. And, with it just falling back and really just hugging this line, I think, we're certainly not breaking that trend that we broke last month. And it's really lining up to continue the downslide that I'm expecting here over the next, I don't know, 3 to 6 months, a year. It's tough to say. It's unfortunately, we don't really get a telegram in the mail when before the markets start to implode. But anyways, and if you hear dogs barking, it's because there's some kids out rollerblading in the street, and the doggies don't like that. They, for some reason, get really upset when people are walking past their house. So anyways, all right, let's go ahead and read the market recap for today. Stock market today, Dow wins brutal April with big losses, tech tanks, written by our friend Yassine Ibrahim from investing.com. The Dow slumped Friday, closing out a brutal month for stocks as a wave of big tech earnings this week failed to coax the bulls out of hiding. Amazon fell more than 14%, suffering its biggest one-day loss since 2006 after the e-commerce giant reported softer second quarter guidance following an unexpected quarterly loss as the value of its stake in Rivian hurt results. I think Rivian, the electric automaker, is down nearly 80% since going public last year. Guys, stay away from electric cars for now. I mean, the Tesla ones seem pretty decent, but I don't know if I'd want to have that repair bill, 5 to 10 years down the line when the batteries wear out, because they're going to cost you probably half of what you paid for the vehicle, brand new. So, I'm a fan of the combustion engine. It seems to work really well right now. And until they work out the kinks and, find a way to have a smaller capacity battery, or a smaller battery that with greater capacity, or, figure something else out. I just don't see the current technology being a long-term solution. All right. Quote, a weaker than expected 2Q revenue guide is taking a bite out of the bull's thesis for Amazon that is predicated on accelerating revenue and operating income growth as we move through 2022. Deutsche Bank said in a note as it cut its price target on the stock to 3,500 from 4,100 a share. Apple, meanwhile, handily beat fiscal second quarter estimates, but missed the guidance and flagged the impact of the demand and supply chain troubles in China. The stock fell more than 3%. The tech giant delivered a record quarter of services revenue amid growing install base. But increasing macro uncertainty and inflationary pressures will likely result in lower product demand during 2022, Credit Suisse said after lifting its price target on the stock to 169 from 168. Wow, a whole buck. The slew of tech earnings seen this week from mega cap tech, including Alphabet, Meta Platforms, Microsoft, Apple, and Amazon, which collectively make up more than a quarter of the S&P 500 weighting, was seen as a pivotal week that could either add to the negative sentiment on the broader market or provide much needed stability. I think we saw where it went. It didn't exactly create stability. The added pressure from a rising interest rate environment, which hurts sentiment on growth, could force investors to rethink how much of a role big tech will play in their portfolios. Quote, "These are stocks that have propelled the market for years, and now we're going to have to get back to more of an equilibrium." End quote. Eric Ditton, president and CEO of the Wealth Alliance, told Investing.com in an interview today. Quote, "These stocks, as we've said for a long time, are just way over-owned." End quote. Semiconductor stocks were also played role. Wow, the English on these people. In the broader market sell-off as Intel Corp fell nearly 7% following weaker than expected second quarter guidance amid supply chain bottlenecks and softer PC demand. AbbVie, meanwhile, cut its full-year guidance after reporting mixed quarterly results as revenue fell short of estimates. Its shares fell more than 6%. In other news, Tesla closed in the red after chief executive Elon Musk said he wouldn't be selling more shares to fund his $44 billion Twitter take private deal. Tesla sold about $8.5 billion of Tesla after agreeing to buy Twitter. All right, so not the best day in the markets like we already talked about, but these things do happen. So, all right, well, let's go ahead and take a peek at some of the economic data that's come out this week. We're going to go ahead and start with initial jobless claims. They came in at 180,000, right on forecast. And looking back historically, we've been below 200,000 for what, 1, 2, 3, 4, 5, 6. So 5 out of the last 6 weeks. So which is really, really good. It's good to see that trend maintain under 200,000, which is what we would consider fairly normal under normal employment circumstances. Continuing jobless claims came in at 1.408 million. The forecast was 1.403 million. So 5,000 over forecast, but again, certainly in line with the historical trend where we've been the last, or really since the first of the year. If you look back to the first week of January, we were around the 1.7 million on continuing claims, and we've chipped away about 300,000 off of that. So again, certainly, there are some bright spots in the economy. I know I'm always pointing out the tallest midget in the room, but there are some good things out there. U.S. durable goods orders month over month came in at a 0.8%. Forecast was 1%. So just a hair below where they were forecasting. It did improve from last month's negative number of negative 2.2. U.S. consumer confidence came in at 107.3. The forecast was 108. So consumer confidence it has waned since when was this? June of last year. It was at its highest since this whole Corona BS started. But it hasn't fallen back to where we were at the beginning of the pandemic. So I guess we'll call that a win. U.S. new home sales came in at 763,000 for this month. Forecast was 765, so 2,000 under forecast. Did fall back from last month's number of 772 and 801 back in the February numbers. But again, still looks pretty good. I know some of the articles I've been reading of late have talked about the slowdown in home building. So we will probably see, especially with interest rates getting back to normal. It's funny to see people freak out about having interest rates go up to 5, for a mortgage. It's like, dude, my first house back in the late 90s, I think we were paying like 7%. And, our house in San Antonio was probably in the 6s. I mean, and those were, for people with perfect credit scores. So, I mean, I was a debt collector back in those days, and credit scores were something I paid a lot of attention to back then. So, anyways, all right. Next bit of data: the U.S. gross domestic product came in at a negative 1.4. So that is not good to have a negative quarter for GDP. What that means is we're halfway to recession, because a recession typically, to meet the definition of recession would be two consecutive quarters of negative GDP. So if when the numbers come out 3 months from now in July, we would, if we have another negative quarter, that would pretty much signal that we're right in the middle of a recession, which, I think we're there already, but a lot of these folks are holding on to hope that they can provide a soft landing and keep the economy moving along. I don't, because these people are idiots. Again, if I can't reiterate this for the 10,000th time, people who work for the government are the most unimpressive idiots you will ever meet in your life. I grew up near NASA. I can vouch for it. So, all right, where are we? U.S. Michigan consumer sentiment came in at 65.2. The forecast was 65.7. Again, did bump up from, where were we in March? We were at about a 59 number. So it has improved, but the sentiment is not all that great. So, all right. Well, that's everything I had there as far as economic data that came out this week. I got two brief articles I'm going to blaze through. I'm actually doing pretty good on time. So, all right, let's go ahead and bring up this first one. Dollar surge leaves trail of destruction. This is written by Saikat Chatterjee and Sujata Rao from Reuters. Is there no Bill Smiths out there? I mean, seriously, people. The dollar's race to 2-decade highs is leaving a trail of destruction in its wake, exacerbating inflation in other countries and tightening financial conditions, just as the world economy confronts the prospect of a slowdown in growth. Again, if you weren't aware of this, you haven't been paying attention, and you deserve anything bad that happens to you. This year's 8% gain against a basket of currencies is driven partly by bets that the U.S. Federal Reserve will raise interest rates faster and further than other developed countries, and partly by its status as a safe haven in times of turbulence. I think the dollar will probably fail within the next 5 years. We should probably have like a one of those, like a death pool, like you have, like Betty White's going to die in February of 2022, and you win the pool or win the pot. We need to have a pot for, when the dollar's going to finally collapse and create and cause the government to, to crater behind it. So, anyways, it's also supported by Japan's reluctance to ditch its super easy policies and fears of recession in Europe. Here are some areas affected by the dollar's muscle flexing. First is exports. Currency weakness normally benefits export-reliant Europe and Japan, but the equation may not hold when inflation is high and rising. Eurozone inflation hit a record 7.5% this month, although so far European central bank policymakers blame it mainly on energy prices. Yeah, it couldn't have anything to do with all the currency you created. Bank of Japan boss Haruhiko Kuroda still views yen weakness as a positive for Japan, but lawmakers fret that the yen at 20-year lows will inflict damage via costlier food and fuel. Half of Japan's firms expect higher costs to hurt earnings, a survey found. Number two, tightening becomes frightening. A rising U.S. dollar tends to tighten financial conditions, which reflect the availability of funding. Goldman Sachs estimates that 100 basis point tightening in its widely used proprietary financial conditions index, the FCI, crimps growth by 1 percentage point in the following year. The FCI, which factors in the impact of trade-weighted dollar, shows global conditions at their tightest since 2009. The FCI has tightened by 120 basis points in April alone, as the dollar has strengthened 5%. Emerging markets tend to have especially high levels of dollar debt. Emerging market conditions have tightened. I think that's emerging markets, EM conditions. Let's see if there was anything else. Yeah, I'd say it's emerging market. Conditions have tightened 190 basis points this month, led by Russia. Goldman's FCI shows the U.S. FCI is at its tightest since July of 2020. Quote, it has to be concerning given everything else that's going on. This is just the time you don't want too much tightening of conditions, said Justin Anowski, portfolio manager and at Legal and General Investment Management. Number 3, the emerging problem. Almost all past emerging market crises were linked to dollar strength. A 10.5% jump in 1993, followed by a 4.6% rise in 1994, for instance, were blamed for triggering the tequila crisis in Mexico, which was followed by meltdowns in emerging markets in Asia, as well as Brazil and Russia. Dollar strength means higher revenues in local currencies for commodity exporting developed countries, but the flip side is higher debt servicing costs. Median foreign currency government debt in emerging markets stood at a third of GDP by end of 2021. Fitch estimates compared to 18% in 2013. Several developing countries are already seeking IMF World Bank assistance, and further dollar strength could add to those numbers. Number 4, no relief on commodities. The rule of thumb is that a firmer greenback makes dollar-denominated commodities costlier for consumers who use other currencies, eventually subduing demand and prices. This year, however, tight supplies of major commodities have prevented that equation from kicking in, as the Ukraine-Russia war has hit exports of oil, grain, metals, and fertilizer, keeping prices elevated. Quote, when you see what's happening in Eastern Europe, it swamps anything the dollar is doing, end quote, LGIM's Onwuski's said. And lastly, number 5, good for the Fed, or good for Fed. The Fed might welcome a rising greenback that calms imported inflation. Societe Generale estimates a 10% dollar appreciation causes U.S. consumer inflation to decline by 0.5 percentage points over a year. If dollar gains continue, the Fed won't need to tighten monetary policy as aggressively as anticipated. Yeah, I don't think I don't think they're getting out of raising rates and getting rid of the balance sheet. Notably, the dollar surge of the past week has also seen money market bets on Fed rates hikes stabilize. BMO Markets analyst Stephen Gallo said if the Fed's trade-weighted dollar index were to break above pandemic time highs, it is currently 2% below that level. Quote, that might be something that would be enough to cause the Fed to deliver a less hawkish hike next week, end quote. That might well mark the top of the dollar, he added. Yeah, I don't think they're going to do less than 0.5%. I mean, as much as these people in the banking and financial sector would love to keep rates at zero, just because it perpetuates the drunken spending that we have in our economy, it helps them out, but it doesn't really help out the everyday person who keeps their money in dollars or buys things in dollars. It just makes things a big mess. All right. And lastly, how will the stock market respond to a 0.5% rate increase? Written by Michael Molinsky. Let's dive in. The Federal Reserve is likely to raise its benchmark interest rate at next week's meeting by 0.5 percentage point. We haven't had a rate increase that high since the dot-com bust in 2000. Wow, a whole 20 years. If we didn't have a 0.5-point rate hike, how would the stock market perform? The Consumer Price Index rose 8.5% in March from a year ago, the biggest annual gain since December of 81. Rising inflation prompted the Federal Reserve to turn more hawkish. Treasury yields have jumped, and the stock market, particularly in the tech sector, has taken a beating. The 10-year Treasury note is nearing 3%, a rate in which it hasn't hit since November of 2018. As of Thursday, the odds of a rate hike of 0.5% to 0.75% was 98.7%, compared with 1.3% for an increase of 0.25 to 0.5%, according to the CME Group's FedWatch tool, which tracks interest rate futures. As of now, no one is betting the Fed would raise rates 0.75% or higher, despite some chatter of that possibility. I'd like to see it. I'd like to see things bring the economy to a screeching halt, if that's what you have to do, just like Paul Volcker did 40 years ago. To drag this out and have this lead to a long-term recession would be the worst thing possible. A study conducted by Dow Jones Market Data analyzed how markets reacted to the last 5 interest rate hikes of 0.5% or more, both before the hikes were announced and in the weeks and months that followed. So you can see here for the Dow, S&P 500, NASDAQ, and the Russell. Looks like, leading up to it, you have a little bit of a down market. Looks like the NASDAQ was the worst 2 weeks out. It was down 3%. The Russell was down 2%. But, a year later, The Dow's up 22, S&P 500 average is up 17 and a half. The Nasdaq's up 18 and three quarters, and the Russell 2000 average is 15.87. So, a year from now, whenever things bottom out, or probably 2 years from now, things will be back on track. Unfortunately, the world may not look the same just because a lot of companies may be gone. But that's just the way the business cycle works. The ones that aren't successful when you go through a downturn, those are the ones that fail, and the successful companies either buy those companies up and take, keep the assets, sell off the rest, fire all the worthless employees, or if a company's, it's actually a good thing. It's kind of like going through two-a-days when you were a young man playing football, or like boot camp. It's a hard test. It sucks while you're going through it, but usually stronger when you come through it. All right. Since June of 1989, there have been a total of five rate hikes of 50 basis points or more. The most recent was May of 2000. Before that, there were 3 rate hikes of 0.5% in February of 95, August of 94, May of 94. There was a 0.75% rate hike in November of 94. As you can see, the markets reacted negatively to rate hikes both 2 weeks before they were announced and 2 weeks after. But after the 2-week period following the hikes, the stock market gained, and in some cases sharply. Granted, the economy and the markets have changed since 2000. You're telling me. Still looking at how the markets reacted historically to those rate hikes may give investors a glimpse at how the markets might react this time. Quote, over the past couple of months, we have seen rates increase at one of the fastest paces in decades. Thus, even as the economy has done well and earnings continue to grow, those higher interest rates have acted as a headwind, said Brian McMillan, Chief Investment Officer for Commonwealth Financial Network. Quote, markets already expect and are pricing in substantially higher rates. From here, any more damage has to come from interest rates moving even higher than the current substantial increases expected, end quote. In other words, investors may expect some downside and volatility both in the 2 weeks before the Fed's May 3-4 meeting and in the wake of the announcement. After that, history says to look for the market to bounce as the economy and markets absorb higher interest rates. So I actually would not agree that we're going to get a bounce off of this. I think we are probably headed for some sort of a downturn, and it'll eventually hit a trough. But it's I would expect probably the Dow is sitting right now at about 32,000. Historically, if it keeps up with the previous trends, I'd expect the Dow to bottom out probably around 16,000. Whenever that bottom might be. That's just my own educated guess based upon 16 years of doing this. So again, if I'm wrong, I will gladly call. If 3 years from now we haven't gone through a major downturn and we've righted the ship, and President Brandon has brought peace and prosperity to America, I will eat my words. And because at least I'm someone fair. I'm not like a Republican or a Democrat who only hates the other side simply just to hate them. I actually dislike these people for their policy positions and how horribly they run the government. It has nothing to do with if they're a boy or a girl, black or white, gay or straight. That shit doesn't matter to me. But it's the fact that they rob me blind every year to spend on worthless vanity projects like our military and all the stupid welfare that we hand out to all the federal workers. It's just the post office can't even make a profit. I mean, they come to the federal government every year with their handout asking for more money. So anything the government does is usually crap. And anyways, I'll stop there before I say anything too mean. So, all right. Well, I hope everyone has a fantastic weekend. And if you need anything from me, don't hesitate to reach out. You can go to dsafinancialgroup.com. All my information is there. If you want to book a meeting, drop me an email, or, you could even call me. Phone hasn't rang yet, but you're welcome to call anytime. All right. Well, I hope everyone has a great weekend, and I'll be back on Monday with the weekly economic update. Adios.